Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good buddies, Ken McElroy and Jeff Snider. And I was just telling the guys that every single time I talk to Kenny, he's telling me what it's like to deal with these banks daily. And when he's telling me this stuff, I'm like, man, I wish Jeff Snider could hear this, because Jeff always talks about what's happening with the banking system, but he's doing this from a 30,000 foot level. He's seeing all the charts. He's seeing all the yield curves and the near-term forward spread, and he sees money being tighter and tighter and tighter, and this impacting the Eurodollar system. But he doesn't see it, what Kenny's seeing, and he's not talking to these regional banks. He doesn't have the boots on the ground intel, and Kenny is dealing with these banks face-to-face daily, but he might not have that 30,000 foot view. So I wanted to connect these two guys, and I wanted Kenny to download and tell Jeff exactly what he's experiencing. And then Jeff can kind of interpret this through the lens of what he's seeing with all these curves, interest rate curves, with the regional banks, and of course, the bigger picture with the global monetary system. So Kenny, do you want to start off by just kind of explaining to Jeff what you're dealing with daily here?
Certainly, of course. Thanks, Jeff. Always great seeing you. So a couple things. One, so we own about $2 billion worth of real estate, and we currently have 6 projects in construction. We're buying several. These are mostly multifamily, and I'm actually buying a company, and we're in the middle of refinances and all kinds of stuff. So, what we do is we package limited partner investors, high net worth people into deals. And so I wanted to start there, George, because one of the things that's happened in the last 2 years or 18 months, I guess, is you think about when I was just trying to attract capital. This is like equity. I was able to do it at 5-6%. Well, now you can't, because so equity is repriced.
Meaning what you're offering your investors. You're offering
they're not going to, because they can get a T-bill for 5-6%.
Right.
So they're not going to give me money and put it in a real estate deal. So that's changed the equity landscape a lot. And then of course on the debt side, that's changed a lot. And so debt's gone up, and typically debt is priced obviously a little bit less than equity. So when because debt is in first position on all these deals. So when debt is, let's say 7 today, that means equity needs to be at least 2 to 3 points higher. Okay, so all that does is make it harder to do deals for guys like me.
You got to pay a lower price for those deals.
You got it. That's it. And so that's affecting cap rates. The cap rates are going up, values are going down. So specifically on the commercial side, what we're seeing is values are 20-30% lower for certainly multifamily, industrial, retail, office is in really bad shape for a different reason, work from home. But so and then the lenders, what they're doing with guys like me that have been sponsors of 30 years doing this, is they're making us put more money down on reserves, and we're like 55% loan to value.
Yeah, that's what I was talking about the other day, Jeff. So, Kenny, can you explain kind of, because the way you communicated this to me when we were hanging out in Park City a few weeks ago is that rewind 2 years ago, and these banks were literally just throwing money at you. Kenny, anything you want, you got it. Just and at what, a 70% loan to value?
Yeah, guessing? Exactly. Yep.
And at very low interest rates. And now what they're doing is they're saying, whoa, Kenny, we've got a 30-year relationship with you. We know that you're a pro. You're not just some amateur, but we want this buffer. We're going to take the LTV all the way down to 55%. And so for someone that didn't have your experience, that LTV would go down to pretty much zero. Is really the bottom line. But they're saying what we want you to do in addition to that is put in this money effectively in an escrow account. And when they say money, they're not talking about $500. They're talking about $2 or $3 million. Correct. That they want you to put into this escrow account just to cover their ass in case interest rates go higher or cap rates go down or the value of your property goes down or what you're building. If it doesn't pan out as far as your occupancy rates, your cash flows go down. Is that what they're saying to you?
Yeah, that's an interest reserve. They're certainly doing that. And one of the also bigger stories is when people were doing deals in 21, let's say 20, 21, 22, a lot of times they were doing what's called short-term bridge money. and that has a very short life on it. Let's call it 3 years. And a lot of people did not buy rate caps. And this is a big, big problem. So, we bought rate caps on everything, just been there, done that. At the time they were 50 grand, they were nothing, so we bought them, and thankfully we did. A lot of people didn't. So, so when they come in at 3, let's say, or 3.5 or 4, and now they're, 7 or 8. So the exact same project, now has much, much higher interest costs. And so we're starting to get to the end of those. And, because these are usually 2, 3, 4 years. And so we're starting to see extensions, but there's big money that you have to put up in order to get a rate cap extension. So we're having that issue too. So you have the difference between the fixed rate and the variable rate. And that's another big tsunami coming.
Yeah. So if someone's rolling over their debt, the bottom line is, let's just assume they can roll over their debt, because I want to be very, very clear. Kenny has been doing this for, like he said, 30 years. He has incredible relationships built with these banks. If you're a big shot in the real estate business, but you've only been doing this, let's say 10 years, and let's just assume that you've been doing very, very well, you are not going to get the same terms as a Kenny McElroy. That ain't happening. So we could run into a point here, Kenny, and correct me if I'm wrong, where a lot of these investors that have done well over the last 10 years but don't have your track record, they go back to the bank and say, hey, I need to refi my loan. And they say, yeah, no, not at any price. You're done. And even if they do, they say, okay, well, you're going to need to pay for an interest rate cap that's now $1 million instead of $50,000. And they're going to say, I can't afford it. I'm negative cash flow on this property anyway. I don't have my bridge loan that you promised me that I was going to use to do the improvements to up the rents. So now I'm stuck high and dry. I think a lot of these investors, even in the multifamily space that most people think is still pristine, they don't understand that a lot of these investors are in that position.
Without a doubt, a lot of the general partners are in this position. There's several things happening at once. The first thing is that the real estate has been repriced. So if you bought something and you put 20, 30% down, that's gone. The period. You're looking at if the property is worth the loan. That's number one. So now if you're talking to the bank, a bank's not going to give you a 100% loan. They're going to say, we need you to write a check, probably a big check, and maybe we'll finance 60%, of that old loan amount just to keep it. So we're talking about cash calls at this point.
Yeah. So Jeff, now that you've heard that, I'm sure that doesn't surprise you, but it's information, like boots on the ground information that you didn't have earlier. So what's your impression of what Kenny just said?
Well, there's a couple things. And George, you raised this earlier when you said, we should talk to Kenny about this. Is number one, I think most people, myself included, when we talk about trouble in the commercial real estate sector, we're thinking, office buildings and retail properties, because that's where most of the focus is. And when you said, no, Kenny's talking about multifamily projects, it's like, that was sort of a shock, because multifamily from the outside appears to be perfectly fine, or at least the cleanest dirty shirt in the commercial real estate laundry bucket. So the fact that you're talking about this stuff going on with multifamily real estate that's eye-opening already, right from the get-go here. The second thing is, when you hear about, something like tightening lending standards, what does that actually mean? And Kenny, you're basically explaining it here. Tightening lending standards means a lot of different things, but if it means you got to come to a deal with extra cash or extra equity, that's a tightening lending standard that has massive implications further down the road. So, from my perspective, you hear about, data like Sleuth that tells us that, banks are saying they're tightening lending standards. Okay, well, what does that actually mean? And it can mean a bunch of things. But if Kenny, what you're saying, and I have no reason to doubt why, or, what you are saying, the banks are saying, loan to value ratios are going way down. That's a huge one. I mean, especially for multifamily real estate, that's another big one. And I think, to me, what the biggest thing I'm hearing from you guys is that banks are being incredibly defensive here,
right?
Which is a really bad sign, because we haven't really seen anything bad happen yet. It's almost as if, like, the banks are saying, we don't expect this to go well, so we're going to build up our cushions, whether it be a cash cushion, an interest rate cushion, or a valuation cushion. And we're going to force that onto the borrowers, especially as they come looking for refinancing loans. So there's a lot of it here. There's a lot of on the ground details that is incredibly
and then it becomes a
helpful.
foregone conclusion, right?
Yeah,
Because
well,
they're worried about these guys going bust, but their policies are forcing them to go bust.
Well, it's sort of the chicken and egg thing here.
Yeah.
Or, you know, it's self-reinforcing. And really what the banks are saying is we realize these people are going to walk away from these deals. So we got to get the best terms we can, knowing that once the defaults start, we got to be protected from that behavior. And, you know, again, George, we see this type of behavior in crisis too, where banks become defensive and they also become very narrow focused on just their own portfolios. They don't take a bigger picture look at, like you said, the tighter they get in lending standards, the more they demand from their borrowers, the more likely it is their borrowers are going to have to default. But
right,
they get this tunnel vision on, okay, we just need to make sure that we get the, you know, minimum standard. We got to get everything above a certain level, a certain cushion, just to make sure that, you know, when the default actually happens, they've gone beyond thinking that defaults might happen to, okay, when they do, what are we going to do about it?
Yeah, and what I hear in the mainstream media all the time is that, all the problems with Silicon Valley Bank, Signature, First Republic, those are all behind us because the Fed came in with this bank term funding program, and therefore we've got nothing to worry about. The Fed and all the geniuses, you know, in their PhDs, they came in with this elegant, clever solution. So now, you know, nothing to see here. Let's just move along. But when you listen to this, when you listen to what Kenny's saying, you're like, whoa, maybe the bank term funding program didn't really solve the problem.
Well, now it makes sense. I mean, the bank term funding program continues to go up. By now, I mean, we're how many months now? 6 months after Silicon Valley Bank. It should be going down. It should be going down substantially. Now it does make sense when you hear what Kenny's saying about his view from the other side of the banks, who are they're tightening up dramatically. So other banks and other institutions are going to be looking for different alternatives for financing and funding.
Yeah. And then, so Kenny, how is this impacting your process when you're calculating what you're willing to pay for a deal?
Well,
because
so
you're always out there hunting, and I know
Yeah.
you're building right now, but I would assume that you're basically doing the exact same thing the banks are. You're looking at your own
Yeah.
balance sheet saying, how do we shore this thing up? And if I do even consider a deal, it's got to be at pennies on the dollar. We got to find a super motivated seller, or I'm just not interested.
Yeah, well, a couple things. One, every single week we have an investment committee, and there's 7 people on it, and we look at hundreds of deals a week, and we've been offering for the last 2 years. And I don't know if you know, George, but I only bought 2 in 2 years. And I always stick to my math. You know, I've been around this business enough to know that it's got a cash flow on day one, because things happen. So now I'm licking my chops because same program, same stuff. We're seeing now distressed sellers. We're seeing sellers we're selling sellers pull their properties off the market because they thought they were worth more, and then they wait, and then the rates just kept going up, and so now they're coming back with lower rates, and so there's a lot of brokers trying to do what they call brokers' opinions of value on, repricing stuff, and they're seeing it go down, and that is because we haven't even touched on operating expenses from all this inflationary stuff is just nuts. So our insurance premiums are up 30%. Now property taxes are up, utilities are up. So now that might not seem a lot, but on my little company, that's our premiums are $4 million. So that's a $1.2 million hit, and just with me. So these are and rents are not going up to cover that. So things, all kinds of stuff are happening, and so I'm always trying to solve on the cash flow that I can make from the property, and so as those things start to squeeze down cash flow, you offer less, period.
Yeah.
You have to offer less to maintain returns. And then I'll tell you another sleeper in there is construction. So if I started stuff, we're building 2 years ago. Now, 2 years ago, construction loans were 4, let's say, and my costs were what they were. Well, costs went up, and now construction debt is 8-9%. I even heard as high as 10 in some cases. So, and not fixed. So now you're seeing these people finish their projects if they can. They have to get additional funding for sure, and then there's going to be a big gap, George. So
yeah, they're cash flow negative because they did not. They're doing their numbers based on a 4% debt.
You got
now
it.
they're at 8%.
Yep.
Yep.
Not to mention the fact that there's no new construction that was built during this time. I mean, or started, I should say. I'm generalizing, but you get the point. There's a massive supply problem coming. It's going to hit in 25, probably 26. We're severely undersupplied with housing, and
Yeah, but we're also undersupplied when it comes to income.
Yeah, I know.
That's where rubber meets the road, because I hear that argument all the time. Well, George, housing prices are just going to go up forever or rentals, because there's this big gap, home prices up here, rentals here. So the rental prices have to go up to the home prices, or the equivalent amount of what a mortgage payment. I'd say, listen, that's assuming that the average Joe and Jane is not constrained by income. And I've got news for you. They actually are constrained by income, believe it or not.
Yep.
Well, that's the big thing, right, Kenny? I mean, the other stuff is important, but if the incomes are topped out, or if there's a ceiling on them, it filters down into everything else. It makes life more difficult for the banks, makes life more difficult for you. I mean, you got to make the numbers work, and if you got no real ability to pass along costs to your customers, I mean, geez, that's another huge headache.
Yeah, yep. Hey, Kenny, before you go, I want to just rephrase what Kenny said, because remember he said we've looked at thousands of deals and we've made an offer on, or we've actually purchased 2 of them.
Yeah.
So let me actually kind of translate that. If Kenny only bought 2 of them out of 1,000, that means that 998 people overpaid. and seriously, and those are the people that could be giving the keys back to the bank. So my question for Jeff is, Kenny's looking at this through the lens of the real estate investor, but how are the banks looking at this, understanding that a lot of those keys for these apartment complexes are going to come right back to them, and what does that do to their balance sheet?
Well, I think that's why we're seeing so much. I mean, from Kenny's perspective, as well as other perspectives, that I think that's why they're being so defensive. They're getting ready for the moment when the tide really comes in, right. when the refinancings really start to hit. And, I think it goes, Kenny, you correct me if I'm wrong here. When you start refinancing, there's a little bit of a negotiation. There's a little bit of a dance there. Yep. It's not always done right away. So I think some of these refinancing processes are going to get stretched out as long as possible. I think it's going to be the banks who are trying to delay it, stringing these property developers along just because they don't want them to default. But I don't know necessarily what the end game would be, other than maybe just hoping the economy or the system magically fixes itself. And if we just extended enough, a few more months, then maybe we won't have waves of default. But I think overall, that's why the banks are becoming so defensive, is because they can see that the numbers just don't work in a widespread fashion. It's not just 1 or 2. It's a lot of them.
Right. The pushback you're going to get there, though, Jeff, is, well, listen, the Fed's going to come in. They're going to drop interest rates. Problem solved. So I don't know why you guys are sitting here fear-mongering. I don't know why you're worried about all this stuff. We've got a very elegant, clever solution. We've done it in the past. We've seen this movie. We know how it plays out.
Yeah, and this movie,
but what they don't understand,
the rate cuts don't happen until after the crisis, number 1. Number 2, rate cuts aren't going to fix what we're talking about here.
Yeah, can you explain that further? Because to the point that you've made very well so many times is, just because we have cheap money doesn't necessarily mean we have loose money. Money can be very, very tight and cheap at the same time. In fact, usually those kind of go hand in hand.
Well, yeah, as Kenny's talking about, the banks aren't going to just magically, as interest rates go down and the economy goes in the toilet, banks are going to just magically untighten their lending standards. They're not going to say, oh, now we're going to go back to 80% loan to value from 40 or whatever we were just before. They're going to wait and ride this thing out. They're going to wait till the upside of the cycle before they start loosening standards again. So interest rates could go down. The economy might even, bottom out. I wouldn't expect that all that much, but that could happen too. And the banking system is still going to be sitting there saying, we really don't want to lend until we're absolutely certain we're through this part of the cycle.
Yeah, very well put. Kenny, I know we're running short on time here. what questions do you have for Jeff as far as what he is seeing in the macro data that might help you better understand what the banks may be telling you, let's just say in the next 6 months?
Sure. Thank you. Jeff, as always, it's great to actually get you one-on-one here. So obviously we're trying to play the interest rate game. So if anybody had any kind of short-term money at all, which is most of the markets, that's the first question. Where do you think, because people are buying rate caps right now, they're buying these rate caps and we're extend and pretend, I guess is probably the best way to put it. And then the next piece would be, the office market, we all know, the mall market, retail, all that stuff, going through annihilation here. A lot of times the banks are the same banks. It's not like a bank is a bank. It's not like they can lend to all three of us here. We could be all doing three different kinds of things. So what do you see with the banking system? Because it looks like most of that debt's held in the regional banks.
Yeah, I actually wanted to ask you a question first because I think that's what we're kind of piecing together, just talking amongst ourselves here, is that I wonder if that's one of the reason why banks are being so defensive about multifamily real estate. It's what you just said.
All right.
They can see the real freight train is over there in the office space or the retail space, and so they're trying to get we gotta tighten down the screws everywhere, because we're going to take a massive hit, maybe not in multifamily stuff, but maybe in office and retail. And so we got to tighten up the balance sheet all across the board, that's the worst case scenario. When banks are saying we can't compartmentalize one part of our portfolio, we've got to apply strict metrics all across everything we do, because we really see some pardon my expression here, we see the shit hitting the fan and it doing it over here and then just impacting everywhere else. Is that kind of what we're thinking here, Kenny?
Yeah, without a doubt. I obviously, for just to make it simple, retail got annihilated because of the online, called the Amazon effect, right? And so we've all been watching the malls, the regional malls, kind of go down in front of us. Now that's making its way to other spots. Now that's one, but then two, the work from home thing really disrupted office, and very much so. And a lot of people changed, whether they're coming in or not. So there's no way that debt can be serviced when it's 50% vacancy. No way. So and so all the equity's gone for sure. But most of that money's held, as you know, in insurance and pensions and stuff like that, on those big trophy properties. But there was a property in San Francisco, the Wells Fargo building. It was $250 million 2 years ago. It just traded at 70. And, so I think to myself immediately, okay, somebody wrote down the debt, all the equity's lost. It's making its way through these somebody's statements somewhere. It certainly wasn't high net worth LPs like I use, but that's starting to make its way. It's real. That stuff is real, and it's impacting banks that we're trying to borrow from.
Kenny, what percentage of these deals that you do, or I know most of your buddies are in the space as well. So when we look at these apartment owners that have multiple properties, how much money are they, as far as the total, how much of the pie chart are they getting from debt? And then out of that, how much are they getting from banks? And then how much are they just getting from like a private equity, like a non-bank entity, like a shadow bank, if you will?
Sure. So I would say the best right now, most of our stuff is agency. So Freddie Fannie would be primarily where we're going for most of our stuff.
Okay.
And that is, I mean, obviously that's non-recourse. That's really good. That's really good stuff. So that's traditionally where we would want to be. However, not all of it, they don't want all of that. So then that goes, of course, to the banking. Almost all construction, of course, is through your small regional local banks.
Okay.
And then, of course, where the private equity groups come in, or the big family offices or whatever, is typically on the equity side, but not always. They do have debt funds and all kinds of things like that. But there's it's basically whatever you can cobble together and have the lowest cost of capital, you know what I mean, at the end of the day.
Yeah.
And we're in a position where most of our stuff these days is agency. And but not everyone's been able to do that.
Yeah, that makes sense.
Have you seen anything change as far as the agency standards too?
Without a doubt. Yeah, that's it. The agency stuff is, the 55%, it was 65, 70 2 years ago. A lot more reserves. And of course the rates are higher. And one of the crazy things, if you can think about this, I had a deal in escrow. We were at 100, let's call it $100 million. It was in Tucson. It was a 350 unit apartment building, value add, perfect project, hadn't been touched in 20 years. I was excited about it. While I was in escrow, the rates, Powell was raising rates. And thankfully I didn't have any non-refundable money up. And my cash flow went from 3 million to 2 million because of the increase in debt. Same project while I'm in escrow. So you can imagine, like, the properties themselves, to your point, Jeff, they're the same properties they were a year ago, with the same tenants, probably the same rents, maybe a little bit more and maybe a little bit more expensive. So there's nothing wrong with the properties. What's happened is debt's gone up and cash flow's gone down. So we had to bail off of that one because we said to the seller, hey, like, our returns at 2 million now. We had to put 30 down, and 3 million on 30 is 10, and 2 million on 30 is a lot different. And we're like, sorry, it doesn't meet our number. And they're like, well, what do you think it's worth? I'm like, well, I think it's probably 82, maybe somewhere in there. And to get back to my number. And they're like, well, we're not going to take an $18 million haircut. And I'm like, well, next, so that's happening all over the place.
What ended up happening to that property, Kenny? Do you know?
The sellers took it off the market, and it's been off the market, so it hasn't come back on. But and most sellers, that's a good question. A lot of these folks, they were told, and they were at one point, these were worth 100. When rates were 3. That's actually what cheap money does. It was 80, went to 100 because of cheap money. Now, because the money's not cheap anymore, went back to 80. You know what I mean? That's all that's happened.
Yeah.
Hey, Kenny, do you see a lot of that going on where sellers are just yanking deals and just sitting on it, sitting on their properties?
100%. Yeah. That's the investment committee call I'm on. My acquisition guys and my analysts, they're just going through deals after deal after deal, and they've seen them. The other thing that's happening is that they're retrading. So they're tying up deals and then retrading as they go. Like, for example, if you're in the middle of a deal and the rates are going up, or you find something, or insurance rates or taxes or whatever go up, you gotta go back to the seller and say, I can't pay this price because what you told me it was is now more.
Yeah. Kenny, is their mindset the people that are just pulling it off the market because, like, we are not going to take 82. We know that 2 months ago, this thing was worth 100. So we're looking at the inversion of the curve. We know that Powell's just about ready to hit the pause button. So we're just going to go ahead and take it off the market because we know darn well that in 2024, Powell's going to, just orchestrate this soft landing or no landing. Rates are going to go back down to 1%. And then my property is going to be worth 100 million again. Then we'll go ahead and sell. So
Wouldn't
we'll
that
just
be
sit
nice?
back and wait for the Fed to do their magic, and them not understanding that if the Fed takes rates back down to 1%, that's an environment where your property isn't worth 100 million, it's worth 50 million.
Yeah. Well, the banks aren't doing that either. I mean, they're looking at the same scenario. George is saying, well, we don't buy that at all. That's what Kenny's saying is they're looking ahead and thinking, oh boy, this
but is that rough. The mindset, Kenny, that a lot of these sellers have? You talk to them, and that's their rationale for picking up. They've got these rose-colored glasses that the Fed is going to bail them out.
You gotta think of the other player, the other character, in the game. It's the broker. The broker's like, hey, and by the way, here's what it's worth, and we're going to list it. And then it goes out to bid, and everybody's bidding, and there's a whole process and all that kind of stuff. And at one point, based on the math, it was. And, but here's the thing, George, as you guys both know, like, rates have punch way through the ceiling, like 3%. You know, even I don't know what people keep. You know, now they're at 6 or 7. Let's say, you know, maybe they go to 6, and you know, maybe they go to 5, but they're still 2 points above 3. You know what I mean? Like they're so far above from, you know, after 11 rate increases and 18 months. I just don't see it coming back anytime soon.
Yeah, very well said. All right, guys. Well, thank you very much for your time. That was an incredible conversation. Guys, if you want to follow what Jeff and Kenny are doing, Jeff, where can they find you?
That's Eurodollar University.
All right. And Kenny?
Yeah, KenMcElroy.com. Just check it out.
All right, guys. Appreciate your time. Can't wait to do it again.
Yeah, see you,
thanks,
George.
Kenny.
Jeff. Thanks. Good seeing you guys.